Hey everybody, Brian Davis here. Super excited to be with you. I am joined today by MC Laubscher. MC is a veteran real estate investor. He's the creator and host of the top-rated business and investing podcasts Cash Flow Ninja and Cash Flow Investing Secrets. He's also a husband, a dad, author, cash flow expert. So MC, welcome to the show.
Great to be here. Been looking forward to our conversation.
Well, me too. And I always love bringing someone on the show who has been investing for several decades in real estate, who's been through a lot of different market cycles, because they always have such a better perspective on wherever we are in that moment of the housing cycle, of the real estate cycle. So let's rewind the clock to the very beginning. I think you said you started in 2001. Is that right?
That's correct. So I'm originally from South Africa. I grew up in a very interesting time in South Africa's history, which that contributed to who I am today. Living in times that are uncertain, a lot of unknowns, volatility, chaotic environment, a lot of disruption. I mean, the complete change of the guard, right? Which is later in life you find out that's actually a great experience that can contribute to you being an investor. When I wrapped up university, I ended up in the United States in 2001. I was playing in a sports league. I was reading and studying. I was that guy on the team bus and team plane.
Love it.
And I always enjoyed history, economics, reading a little bit why, a lot of biographies, trying to connect a lot of dots, reading why and about different opinions, right? I picked up Rich Dad Poor Dad, Robert Kiyosaki.
The little purple book.
Yeah, I had my purple book moment, and 6 months later, I bought my first property. It was actually a property in South Africa at the time in 2001. It was in a suburb pretty close to Cape Town, which is great for commuting, up and coming. I saw the potential, and I bought the place. I got some people in there. I collected the rent, paid all of the costs and fees and expenses associated with the property, and at the end of the month, there was cash flow left. And the question at that stage was, how many times can I do this? How many times can I do this over? How many doors can I get? Light bulb moment. Light bulb moment number two was, as far as cash flow efficiency. And obviously, when you have that first hit as an investor, now school starts. People don't pay rent. People pay them late. If they do pay them, people break your stuff in your property. I mean, I can write a book about that. I've had somebody break a porcelain toilet. I don't know how, but they did. I had to replace that. But yeah, so the school started, and I actually learned the importance of cash flow efficiency, which then again, I read Robert Kiyosaki's book, that purple book, every year, Rich Dad Poor Dad. And, every year I get a new lesson out of it. When the student's ready, the teacher appears. And what happened was, the one year I read it, I said, what are all these liabilities in this book? Well, it's got to be someone's assets. Whose assets are they? It's the banks. And I studied banks, the banking system, the monetary history, the monetary system, studied the book, The Creature from Jekyll Island, and understood how to be as efficient as possible and become my own bank. And then I discovered Nelson Nash, Becoming Your Banker, Infinite Banking. And then I would say, like, the third kind of like light bulb moment, which really elevated and contributed my investing and took it to the next level, was I started to realize that I went it alone and I was always trying to figure out how to do things, which is at that point, especially when you're competing against really, really good players, and I call them cash flow ninjas, it's almost, you can't compete with them, right? Every market's got this big white whale, and you can't compete with them. So the question becomes, how do you partner with them? And Dan Sullivan wrote a book recently, Who Not How. And it was he said he's the ability to put things in perspective. So instead of asking myself the question, how can I do this? How can I figure this out? How can I buy, 100 units or 1,000 units in multifamily if I'm just in single family? That's the wrong question. Who can I partner with and bring my skill set, capabilities, my knowledge, my capital, and my network's capital to the table? And who can I partner with to then go and buy that 500 to 1,000 units of multifamily real estate and resorts and so forth? That was a huge light bulb moment. And what that actually did, taking me into my investing today, is I could diversify. I could partner with the best people in their space, whether it's single family, whether it's resorts, whether it's multifamily, whether it's oil and gas, life settlements. I mean, we could go on and on. You can partner with people and you don't have to be active in that deal consistently. You could be a GP in some deal, but you can be an LP. And that way you can build out a diversified portfolio of cash flow investments that produces income, gets you out of the rat race and the matrix, gets you financially free, reduces your taxes legally, gives you your portfolio a great opportunity to appreciate. And then, of course, you have to have a lot of fun because you get to partner with people and leverage their skill sets, their capabilities, their unique abilities, their network, and their network's capital. So that's kind of what I'm
Absolutely.
up to. It's evolved quite a bit, and I kind of like condensed it. It's 2 decades. So it's, you're not going to get there right away, but those are some of the, I would say, like the key points if I had to pass down, from what I've learned, in, in the School of Hard Knocks.
Well, you're speaking my language there with that third point that you made about you don't have to go out there and buy up these 200 unit, 500 unit apartment complexes yourself. You just partner with people to do it. That is exactly what we do in our co-investing club. We just invest every month as a club in different syndication projects,
Yep.
whether it's multifamily, whether it's outdoor recreation, whether it's self-storage, mobile home parks, retail, industrial, whatever. So we can each spread small amounts of money far and wide by pooling our money together as a club and writing one check to invest in these big projects. And actually, it's super exciting because we are just now this deal that we're in the middle of doing right now. We are just now big enough to start getting those higher returns that you get if you're investing a large sum, those
Yep.
preferential kinds of returns. So it's an exciting moment for us. But you are definitely speaking my language there about investing passively, partnering with people who already have all of that expertise, and they can go out and do all the work, and all you have to do is write the check. So
Right. Right.
I
And
love
the
that.
thing is, the beauty about it is, you could bring a lot of things to the table. Some people, if it's capital, you're bringing something to the table. And then other folks, they bring their skill sets, capabilities, know how, teams, networks, economies of scale. So everybody brings something to the table. And I've loved doing it that way. I love that aspect of investing and business. It makes it fun. It makes it a lot of fun. I've met incredible people through it too, and lifelong friends.
It is absolutely fun, and it's something that Denny, my partner, and I, who I often co-host this podcast with, we talk about all the time how real estate investing is absolutely a team sport. And if you're a solo player and you don't want to work with other people, you're in the wrong space. This is very much a team sport. It's all about networking and partnering with other people. Even if you're going out and just buying single family homes, you need contractors and property managers and realtors, and you have to establish relationships with the local city inspectors. The list is just endless for the people that you need to end up knowing. So
Yep.
anyway, a little tangent there. So MC, you are not a sponsor yourself these days, or are you still sponsoring real estate syndication deals?
I am not currently sponsoring, so it's just because of where we are in the market cycle. So I kind of like look at what's going on, and then I adjust my strategy. That's the one nice thing about being an alternative asset investor is you can use maps, wealth maps as I call them, and you can kind of like see what's going on in the environment where you are at in the cycle, and then you can make adjustments. So not currently, and just on that cycle kind of like theory, here's what I would share with folks too. It's funny how you get different responses, but I just equate it to, a cycle is like seasonality. You've got 4 seasons. When you are in your bathing suit on the beach in Florida in the summer, ready to dive into the beautiful water, where you could see your toes, especially on the West Coast, you're not overly optimistic. It's just summer. When you are in Colorado in snow boots and you're bundled up and you've got almost a balaclava on just to keep yourself warm in the middle of winter, you're not negative. You're just dressing for the weather. It's just that time of the year. It's snow boot time, and it's bundle up and keep nice and warm. So with investing, I look at it the same way. There's different things that you do through a market cycle. There's times to be extremely aggressive. You can over leverage. You can deploy and partner and do as much as you can. And then as the cycle progresses, then you start to play a little bit more defense. And you get to run about the top of the cycle, you're playing more defense than offense. And then, of course, there's a down cycle again, and then the trend reverses. You're playing more offense than you play defense, just because that's where you're at in the cycle. So that's kind of how I look at it. It's advice to that I've learned the hard way. This did not come easy. I wish that I had mentors and people around me to tell me this in 2008 and 2009.
Oh yeah, me too.
Not because, I always say it would have been a much better story if I told people I lost everything and I built it all back up. It would have been a much better story. I got through it pretty unscathed, but the lesson that I learned was tactically, I got in at like the end of 2009, beginning of 2010. But I know what I know now, and I understand these cycles, and I understand the seasonality of capital flows and what you do during different stages. Could have probably bought 5 times the amount of real estate that I was able to buy in the end because I got in too quickly. As people would say, it's like catching a falling knife, right? So you learn it's painful, but you're a little bit older and wiser for the next go around.
Well, so I love that perspective about just the circularity of market cycles, right?
Yep.
I want to hear your thoughts on where we are right now in the real estate market cycle, because I hear a lot of uncertainty among investors, and among analysts and journalists, and there's a lot of uncertainty in the market. So what are your thoughts on where we are right now in the real estate cycle and how investors should be looking at this moment?
Yeah, so there's a great tool that I would suggest that investors look up. If you go to your favorite search engine, type in the psychology of a market cycle of Wall Street, or Wall Street psychology of a market cycle. And people would say, but why would you say Wall Street? Isn't it you're an alternative asset investor? It's psychology. You're dealing with humans. Humans and their psychology drives the behaviors in markets and drives cycles. So yes, you get obviously there's the massive impact of the economic cycle because of the liquidity that is released into the economic environment. But psychology really drives it, right? Capital just moves from one hand to another hand. And we've seen that in microcycles, especially in crypto. So in that chart, the most amount of pain is called depression phase. And this is where you've heard all of the cliches. Blood in the street. Buy when there's blood in the street, one of the Rothschilds said.
Yeah.
And Buffett was always very good with these quotes where he's saying, be greedy when people are fearful, fearful when they're greedy. That's when everybody is freaking out. So that's when the professionals are coming in. And then when the professionals come in, they give an initial bump in the market, and it looks like, oh, there's something happening here. And most people at that stage are so freaked out still, they don't know that that's the cycle has already started. They think it's over. Think tech 2001. Remember when they said that tech is dead? Amazon, by the way, and Google didn't get that memo. The same thing with real estate. I remember seeing in mainstream articles that real estate will never be a warehouse for capital again and wealth. And this was after 2008 and 2009. Now you just laugh, right? Because you're like, that was maximum pain when you get those headlines. So then you get your bump, then more people come in, then you start to see a rally and a recovery. And then there's the confidence, the psychology starts to drive, oh wow, this is coming back. We got to get in. And you have people to see that they come in, and then all of a sudden you get a moment of inflection that really spikes up. That's a really, really good run. Times are great. Happy times are here again. The next phase is where the irresponsible behavior begins. And it happens every single time. It's the over leveraging of people in the marketplace. The examples are endless. Pick a market cycle. You would think of, 2008, 2009. Remember when people that should never qualify to get a mortgage got like 5 or 6 of them, just cash out refied houses and kept on buying more.
Oh, yeah.
That's this part of and this, by the way, is where the pros, the Buffetts, the professional investors go and say, all right, we're out. They get out when they start to see this kind of stuff. In Bitcoin, for example, in the crypto cycle, to compare it to real estate, when people were leveraging their mortgages to buy Bitcoin, all of the pros were out at that stage. So it's kind of the same thing. And then you've got another euphoric spike still because of all this over leveraging, usually by the inexperienced and amateur investors. So there's more to go, right? The pros don't ride it all the way to the top. Nobody can time the markets, right? Look at Michael Burry. Watch the movie The Big Short again. It's incredible. Nobody can time a market. He almost went bankrupt being right.
Right.
Michael Burry.
Oh yeah.
So you have that moment of euphoria, and then the first shoe drops, and it's usually one thing. The first thing, like one thing, and then there's complacency, and then you've got a moment of capitulation. A second thing starts to happen, and then you've got your rundown, and the money's running out for the exits. And at that stage, the Burrys are cashing in, the Buffetts are waiting for the bottom. So where do I think we're at right now? I think the first thing that pulled that drop was the interest rates that basically doubled in 6 to 12 months. So
Right.
I think there's still deals. I still think there's really good deals in the market. At any market cycle, there's good deals, right? There's good and bad deals at any time. There's still good deals to invest in, but people should be very cautious and play more defense when they look at their entire portfolio than offense. So at this stage, I mean, 90% of it could be defensive, 10% could be offensive, because when it comes down, everybody loves a sale, everybody loves Black Friday. But when it comes to assets, people get fearful. They freak out. and I'm like, no, you should be excited about this. If you understand the cycle, this is great news. This means that assets will be on sale soon. And, we're right back basically where we're at. The first shoe dropped with the interest rates spiking. I mean, Burry is again, what is it now, 1.63 billion short. Buffett's in cash. You see the same kind of things. What will be the second shoe? I think it's coming in the banking system. The interest rate spiking up is going to hit bonds where most banks warehouse their capital. So a lot of them have not basically showed their losses on their books, which I think that will eventually be there, but that's more speculative than actually seeing what's playing out. But if I had to make an educated guess, that's probably how that's going to go down.
All right, so interesting. So you think that we are, still at the very top of that roller coaster that is plummeting downward?
Yeah, and like I said, there's still deals. We have still people in our network that are doing some deals. Personally, I am not. I don't have the skill set that some of the folks have that go in and out quickly right now out of deals, or some of the deals that they're investing in doesn't fit quite into my criteria. It might be smaller, it might be in markets that I'm not interested, but it could still work. So there's still deals to be had. There's deals in every part of the market cycle. But personally, I'm playing defense right now, and waiting. And I think like the big lesson is, if you can hold on to capital when there is a massive capital destruction event, and you can go in and then stock up back on assets, at the bottom, it's an opportunity of a lifetime. It's going to be a wealth transfer of a lifetime. And I don't see any of this as negative or positive. I just see it as cyclical. It happens all the time. And you have asset classes where they experience this every 4 years. We've had a one heck of a run in real estate from 2012. Think about it, from 2012 to, I would say, the end of 2022. So 10 years. Wow. What a run. So I think, yeah, still opportunities, but at this stage, playing defense.
Gotcha. We've seen cap rates go up, and we've seen, I mean, obviously interest rates go up. We've seen housing prices drop in a lot of markets around the country. Rents drop in some markets around the country, which is unusual. Rents don't usually drop. I mean, other things go wrong for landlords, of course. Occupancy rates can go down and so forth, but you don't usually see rents drop, even in recessions. So I mean, I would have pegged that we were a little further along in that cycle than you are, but I'm just a guy. so what do I know about what's going on in the market? So you do something interesting with infinite banking, which, by the way, for our listeners, Denny and I talk about infinite returns all the time in real estate investing. That's totally different and unrelated to infinite banking. So I just want to put that out there right now. So MC, tell us a little bit about, just give us like the high level overview of what infinite banking is, how it works, because most people are not familiar with that term. So just give us like the really high level overview.
Yeah, it's a cash flow management system in which you structure your cash flow just like banks do, but you use mutual life insurance companies and life insurance contracts. And if this is the first time that anybody's heard of this, this is what is done by banks, by uh, corporations, and by family offices and the ultra affluent and ultra wealthy. And I've always had a philosophy that you don't have to be a Rockefeller to do what they do. You can look at the blueprints of what they're doing, implement those changes on a much smaller scale in your own life, and get massive results. Over the past decade or so, I've utilized the infinite banking concept strategy as part of a cash flow management system, to warehouse capital. One of the big things right now in this crisis, I mean, it looks pretty much baked into the cake. We had a fork in the road. I think we already took the turn. So the big thing is going to be counterparty risk when it comes to where you keep your capital. So when you look at options of where do you keep money? Well, there's banks. And I think that's where the crisis is going to start. So that's probably not a good spot. Bonds, well, you got interest rate risk. You've got counterparty risk of governments that are all bankrupt, all of them. Pick your country, they're all bankrupt. So then you look at the other areas of, well, actually, where do I keep it? Well, there's a banking crisis and you've got governments that are bankrupt. That's going to hit the financial system. So if you have 401k and an IRA, those folks, unfortunately, are the bag holders in every single crash. That's one of the main reasons they're there, to be bag holders in 401ks and IRAs. So infinite banking uses mutual life insurance companies. They've been around for 170 years. They're outside of the quote unquote Wall Street system. The capital's guaranteed. It grows tax free. You access the cash tax free. It's guaranteed access to your money. And then also you earn dividends when the companies are profitable. And these companies have been profitable every year for 170 years plus consecutively. So when I look at how are people going to behave in the future, or how are governments, corporations, you look at their past behavior. And that's one of the things from a counterparty risk standpoint that I feel more comfortable. I can sleep at night warehousing capital, cash, because I'm going to need it when there's a downturn to buy assets in mutual insurance companies inside of life insurance contracts instead of banks, 401ks, IRAs, and so forth. So I'll share one more thing about the life insurance. Most people think of life insurance that somebody has to die in order for someone else to benefit. But there's actually a different strategy using the vehicle of life insurance, where it's more about the savings aspect and putting money in there because it's tax-free, it's quote unquote off-grid, it's guaranteed, it's out of banks. That's why it's leveraged by the ultra affluent and ultra wealthy. So that's how they do it. So it's structured completely different. It's for cash value, like a savings vehicle. It's been called the rich man's Roth. And folks have probably heard like infinite banking concept, bank on yourself, those type of concepts. So that's what we do with one of my companies. We help business owners and investors structure and set these up so that they can warehouse cash effectively and efficiently outside of banks, so that they can use it to buy assets, during the next downturn.
Yeah. So one thing that I've never understood about infinite banking, and I've heard different experts in infinite banking answer this question differently, and in conflicting ways. So,
not surprised.
well, yeah. So I hear some people make the case, oh, this is an alternative to your bank account, so your checking and your savings accounts. And then I've heard other proponents say, no, this is an alternative to your investment brokerage accounts, your stock and bond investments, your paper investments in a brokerage. And of course, those two types of accounts serve very, very different purposes, right? So which is it? I mean, is infinite banking meant to be an alternative to paper investments or to bank accounts.
It's a savings mechanism. Life insurance is a savings mechanism. It should not be sold as anything else but savings. And this is, a great, I appreciate that question. One of the biggest misconceptions in the Western world, and I would argue the entire world, and this is done on purpose too, in my opinion, but the difference between savings, investing, speculating, and gambling, those are four very, very different things. Very
Absolutely.
different things. And you hear people say, I save in my 401k for retirement. I almost like the, the small amount of limited amount of hair that I have left, I want to pull out when I hear that. No, it's incredible. So saving is when you put capital in a vehicle where it's guaranteed you have a very, very conservative return because you're not putting capital at risk at all. And it shouldn't be tied to financial markets. So that's why it's a very conservative return.
Right.
Investing is when you put capital at risk in the hope. You could do it strategically. I don't like the word hope, but you do it because you're trying to get a bigger return.
No, it's
Um,
calculated risk.
Exactly. It's a calculated risk. You lose some of it or all of it? Yes, you can, because you're
Absolutely.
investing. You're not saving. And then you have speculating. Now, speculation is I would say it's a form of art. It's a little bit more in the trading realm. People see distortions in the marketplace or trends. They put a very calculated bet that that's going to happen, almost like a trader. And then they have a strategy of how to minimize losses, maximize gains. Speculation is a completely different animal than investing. And then, of
Right.
course, you've got gambling, where you have no idea what you're doing. You got a cocktail in your hand, you're sitting down, and you're just, playing some
It's your
blackjack.
chance. Yeah.
You're taking a chance. And unfortunately, I mean, I would even make the argument the majority of people, not the listeners on this podcast, but the majority of people in the world that's just working, just putting money in a 401k and an IRA and maybe handing the rest over to a financial advisor, they're gambling because they don't know what they don't know. It's that whole thing about when you don't know what you don't know and how badly you could get hurt, you're not saving, you're not investing, and you're not speculating, so you have to be gambling.
Yeah. Yeah. And if you don't know, if you don't understand what you're investing in, then it is pure chance, right?
Ye
All right. Well, so that
Absolutely.
makes sense. That answer makes sense to me because one of the criticisms that I've heard repeatedly about the infinite banking concept is that the returns are far lower than the average stock market return over time.
Yep,
And that's an easy thing to measure and calculate, right? I mean, that's something that
yep.
can be easily demonstrated mathematically. So that criticism has always resonated with me. Um, especially when I hear guys, out there touting the infinite banking concept and saying, oh, you don't need Wall Street, infinite banking's got you covered, blah blah blah. And I'm like, well, I mean, the S&P 500 has averaged over a 10% return since 1926. So,
Yep.
and it takes decades for the infinite banking concept to start, reliably producing even even okay, annualized returns. But as a savings alternative, that I understand if you are willing to wait out the policy growing in value, over 10 years or whatever it is. I know it's different based on the policy, but a long time. I mean, it is a long-term investment, and you do have to wait out that policy growth and value. But no, that makes sense, and I appreciate your candor about that. Uh,
Y
MC, how can people connect with you if they want to learn more about what you're doing, either on the real estate side or the infinite banking side? Learning more about calculating or crafting a cash flow investment portfolio.
Yeah, so cashflowninja.com, we got over 1,000 podcasts there. We cover everything business, we cover real estate, crypto, we cover paper assets, come on, everything. And if they want to learn about infinite banking, yourownbankingsystem.com, yourownbankingsystem.com. And I appreciate your points too. They're right on. It's not get rich quick. It's one thing that you do of many things, and that's your
Right.
savings part of your strategy. So how we look at it is that's your foundation, And most of us, we are not looking to get the returns. I mean, it's 3 to 4% tax free in there, but that's not how you get to win this game, get out of the rat race and escape the matrix. How you do it is you warehouse your cash there, utilize it to go invest in things that pay you to own them, like real estate, reduce your taxes and appreciate over time. So it's just one of the buckets. And that's the thing about, I think like the financial world too, I think you summarize it pretty well, is that the echo chambers, we always try to compare things. It's like, should I have real estate, infinite banking, or stocks? And it's like, you can have all three, by the way.
Absolutely.
So, and most people should, in a very well diversified portfolio and strategy, you should have a lot of different things going on. Don't rely on one income stream and one asset, especially in a day and age of today, right?
Yeah, and that's something that I try to be very clear about in all of my writings and speaking. That I'm out there as a quote real estate guy, but I mean I actually have more of my net worth is in stocks than it is in real estate. Stocks and real estate complement each other very well. I mean they each have strengths and weaknesses, which both fit together like puzzle pieces, right? I mean they complement each other perfectly. So yeah, we are all about diversification around here and building out a broad portfolio that keeps you protected from many angles of attack. So
and there are there are many angles. Yeah.
Absolutely. Well, MC, thank you so much for coming on the show today. We really appreciate it. We look forward to having you back soon. And guys, if you enjoy these conversations that we have, please rate, review the show. Makes the world of difference to us. We appreciate it. And we'll catch you next week. Same place, same time. Have a good one.